Welcome to Tech Disruptions, deep dives into the technologies reshaping industries, from AI to quantum to biotech. Let's get into it. Okay, so imagine the tech industry, right? We always talk about it being this magical place of infinite scale, zero marginal costs, software eating the world.
Absolutely. For decades, that was the bedrock. Build it once, deploy it everywhere, basically free. Minimal capital, exponential returns. It was beautiful.
And then AI comes along, specifically generative AI, and it's like someone just hit a giant reset button because suddenly we're talking about trillions of dollars in capital expenditure. We're talking GPUs, gigawatt scale data centers, long-term power agreements. It sounds less like Silicon Valley and more like heavy industry.
Exactly. And here's the kicker. Market analysts are projecting a $1 to $3 trillion spend by the end of the decade just on AI infrastructure. But get this, there's an estimated annual gap of $600 billion between the revenue needed to justify that build-out and the actual verifiable revenue AI applications are generating right now.
Wait, $600 billion a year? That's not a gap, that's a chasm. So how are these companies bridging that kind of financial void? Are they just printing money?
Well, not exactly printing money, but they are turning to some incredibly complex financial engineering. We're seeing things like special purpose vehicles, asset-backed securitization, hardware collateralized borrowing, and this really interesting and frankly concerning circular vendor financing. And the more you look at it, the more you start to hear whispers, serious whispers, about parallels to the 2008 subprime mortgage crisis.
Whoa, the subprime crisis? That's a bold comparison. Are we really saying AI, the future of everything, is built on the same shaky financial ground as those infamous ninja loans?
That's the question we're diving into. It's not about whether AI is useful technology, it clearly is, but about the architecture of the financial ecosystem funding its rapid deployment. And the structural similarities are, to put it mildly, striking.
All right, let's peel back the layers on this because a $1 trillion subprime echo in AI is something that needs a serious deep dive. We've been living in this world where software was king, right? Infinitely scalable, minimal cost to replicate. You write code once and then you sell it to a million people and your incremental cost is almost zero.
Precisely. That was the magic of the digital age for the last 4 decades. It created these incredible asset turnover ratios. A little capital, huge, high margin revenue growth. It redefined how we thought about business.
But generative AI, it's not just a new app or a new piece of software. It's fundamentally different. It requires a physical foundation, a massive amount of hardware, energy, and real estate. It sounds like we've gone from the digital ether to something very, very tangible.
It's a complete paradigm shift. Generative AI forces the digital economy into a direct collision course with the physical constraints of heavy industry. We're talking about extreme capital intensity. Think about it. Hyperscale cloud providers are projected to spend between $1 and $3 trillion on AI capital expenditures by the end of this decade. Just for 2025, big tech capital expenditure hit $427 billion, with estimates for 2026 reaching $562 billion.
That's staggering. So where's all that money actually going? Is it just on fancy algorithms?
Nope. It's directed towards highly specialized graphics processing units, GPUs, the construction of gigawatt-scale data center campuses, and securing massive long-term power purchase agreements. This isn't abstract. It's concrete physical infrastructure. It's pushing the capex to revenue ratio of major tech firms to decade highs, a stark departure from the asset-light models Silicon Valley traditionally embraced.
So these tech giants are essentially becoming infrastructure companies, building digital power plants. But you mentioned a huge gap earlier, $600 billion annually, between this massive investment and actual revenue. How does that work? Are they just building it and hoping people show up?
That's the profound macroeconomic dissonance. This $1 trillion+ investment boom has produced remarkably little immediate benefit. The AI industry is currently spending on foundational infrastructure at a ratio of approximately 15 to 1 compared to the actual revenue being generated by end-user AI applications. That's the $600 billion question venture capitalists are asking.
15 to 1? That's insane. If I was spending $15 for every dollar I made, I'd be out of business in about 5 minutes.
Well, the industry can't rely solely on the retained earnings of the hyperscalers to cover that gap. So the burden of financing has spilled over into the broader debt markets. In 2025 alone, AI related companies and projects tapped fixed income markets for at least $200 billion in debt. And projections show hundreds of billions more in non investment grade issuance needed over the next 5 years.
Non-investment grade? That's starting to sound like those whispers you mentioned. So this is where the financial engineering starts to look like the subprime crisis. Tell me more about that.
This is where it gets really interesting. The argument isn't that AI itself is bad, but that the financial architecture supporting its rapid deployment shares critical vulnerabilities with 2008. The subprime crisis was characterized by securitization of rapidly depreciating assets, circular risk transfer, masking leverage through off-balance sheet entities, and a reliance on perpetual asset appreciation. A forensic look at the current AI cloud market reveals striking parallels across all these dimensions.
So it's not the technology itself, but the way it's being funded that's raising alarm bells. Let's start with the financialization of compute. What exactly does that mean?
It's a fascinating development. A new tier of specialized independent cloud providers, often called neoclouds, companies like CoreWeave, Lambda Labs, Crusoe, have emerged. They're aggressively acquiring vast clusters of NVIDIA GPUs to lease bare metal compute to AI developers. But here's the thing, they don't have the multi-trillion-dollar balance sheets of Microsoft or Google.
So how are they funding these massive GPUs? Those chips aren't cheap.
They're doing it through complex debt instruments, collateralized directly by the microchips themselves. This is the literal financialization of compute. We've seen the advent of the first major GPU-backed asset-backed securitizations, or ABS. Lenders pool physical hardware assets alongside anticipated cash flows from customer lease agreements to issue structured credit.
So just like mortgages were pooled into mortgage-backed securities, these GPUs are being pooled into GPU-backed securities.
Exactly. Lambda Labs, for instance, secured a landmark $500 million loan using its NVIDIA chips as direct collateral, placed into a special purpose vehicle specifically for GPU financing. The subprime parallel is acute. Just as mortgage originators pooled subprime loans assuming housing prices would always go up, these underwriters are issuing data center ABS assuming GPU rental demand will be insatiable and hardware depreciation slow.
But GPUs aren't houses. They become obsolete fast. That's the critical difference, right?
That's the systemic vulnerability. Creditors funding these data centers often use standard infrastructure underwriting models, assuming a 7 to 15-year useful economic life for assets. But the effective economic life of frontier AI accelerators, like the NVIDIA H100, is highly compressed. Older chips become non-competitive for frontier model training within an 18 to 36-month window.
18 to 36 months? That's barely 2 or 3 years. You can't finance a 15-year debt with an asset that's functionally obsolete in 2.
That's precisely the problem. If the underlying collateral backing a multi-billion-dollar debt facility depreciates to a fraction of its value before the debt matures, those ABS tranches become functionally insolvent. It mirrors the collapse of AAA-rated CDOs when housing values plummeted. Credit rating agencies are starting to notice this mismatch between 3 to 5-year GPU rental contracts and 15-year data center leases.
Okay, so rapidly depreciating collateral. Got it. What about this circular financing you mentioned? That sounds even shadier.
This is perhaps the most alarming and direct parallel, not just to subprime, but also to the dot-com bubble. It's often called round-tripping. Major cloud providers and semiconductor manufacturers are systematically investing billions in equity into generative AI startups, with the explicit or heavily implied condition that those startups use the injected capital to purchase infrastructure from the investor.
So I give you money and you immediately give it back to me by buying my product. That sounds less like a sale and more like an accounting maneuver.
It absolutely is, and it's driving the core revenue growth of some of the largest companies on Earth. Take Anthropic. They're projected to pay Amazon, Google, and Microsoft an estimated $80 billion to run their AI models by 2029. Those payments are largely funded by the multi-billion-dollar venture capital investments those exact tech giants made into Anthropic.
So Amazon invests in Anthropic, Anthropic uses that money to pay Amazon for compute, and Amazon books it as revenue. That's a closed loop.
Exactly. And it gets better. These hyperscalers even capture a significant portion of the revenue Anthropic generates if their customers buy the AI models. NVIDIA is doing something similar. They reportedly contributed $2 billion to Xay's data center fund, which was specifically designed to purchase NVIDIA's own GPUs. The supplier is financing its own customer to secure a multi-billion-dollar sale.
That's not revenue, that's self-help. Does this even meet accounting standards?
Excellent question. From a strict financial accounting perspective, this raises severe questions about compliance with FASB ASC 606 guidelines, which require commercial substance for revenue recognition and that collection of consideration must be probable. When a hyperscaler books billions from a startup whose sole ability to pay comes from the hyperscaler's own VC injection, the commercial substance is fundamentally distorted.
This rings a bell from the dot-com era, where telecom companies financed their own customers to buy their equipment and it all went belly up.
Precisely. It creates an immediate veneer of top-line profitability and market demand while systematically masking the underlying rot of the borrower's inability to pay.
You also mentioned special purpose vehicles, or SPVs, earlier. How do those fit into this picture?
SPVs are another direct parallel to 2008, a classic shadow banking tool. To manage the staggering capital requirements of AI without destroying their own balance sheets or triggering credit downgrades, tech companies, neoclouds, and even energy utilities are using SPVs. An SPV is a separate legal subsidiary designed to isolate financial risk, allowing the parent company to aggressively finance massive infrastructure while keeping the associated highly leveraged debt completely off its primary financial statements.
Ah, so out of sight, out of mind for the balance sheet. This sounds like what banks did with toxic assets before the crash.
That's the blueprint. Before 2008, financial institutions used SPVs and structured investment vehicles, or SIVs, to hold mortgage-backed securities off balance sheet. This let them bypass capital reserve requirements and hide their true leverage from regulators and shareholders. When those subprime mortgages defaulted, the SPVs collapsed, and the toxic debt was violently forced back onto the parent bank's balance sheets, triggering a global liquidity freeze.
And now we're seeing this with AI infrastructure?
Absolutely. XI, for example, was reportedly raising $20 billion for a data center via a complex SPV, $7.5 billion in equity, $12.5 billion in debt. The SPV would buy the NVIDIA GPUs and lease them back to XI, using the chips themselves as collateral. This lets XI operate a massive infrastructure footprint while isolating the debt risk. Utilities are also using SPVs to fund power generation facilities for data centers, obscuring their financial risks.
So it's like a financial shell game. And who are the equivalent of the subprime borrowers in this AI scenario? The homeowners who couldn't afford their mortgages?
That would be the AI startups. In 2008, the foundational flaw was the ninja loan. No income, no job, no assets. In the AI boom, it's the foundational model startup. Despite raising venture capital at astronomical valuations, a vast majority of AI startups lack a sustainable path to profitability, possess minimal proprietary technological moats, and generate negligible enterprise revenue relative to their massive compute expenditures.
So they're basically burning through cash, reliant on investor money to pay their massive cloud bills.
Precisely. They are the highly leveraged, high-risk borrowers at the base of the financial pyramid. Just as subprime homeowners relied on continuous housing price appreciation to refinance unaffordable teaser rates, AI startups rely on continuous rounds of VC funding to finance their staggering cloud compute bills. The empirical data is alarming. Over 80% of AI projects never get past proof of concept, and only about 5% of generative AI pilots achieve rapid revenue growth.
So 95% are basically just fluff?
A lot of them. Many are zombie startups, their operational continuity tethered to the artificial infusion of cloud credits from the very hyperscalers hosting them. If capital markets tighten, if VC funding decelerates, these startups will fail to honor their cloud contracts, initiating a violent cascade of defaults that impacts neoclouds, hyperscalers' revenue projections, and ultimately the institutional debt markets holding those collateralized loans. The table summarizes it perfectly: overvalued residential real estate versus rapidly depreciating GPUs, homeowners with insufficient income versus AI startups with zero structural profitability, RMBS versus GPU backed debt, off balance sheet SIVs versus joint venture SPVs, continuous asset appreciation versus continuous VC injections, predatory origination versus circular vendor financing. The parallels are incredibly strong.
Okay, so that's a pretty compelling case for a subprime echo, but it's not a perfect replica, right? There have to be some fundamental differences that make this not 2008, or at least not exactly 2008.
Absolutely. And this is where the critique comes in strong. Many argue that the subprime analogy, applied wholesale, fundamentally mischaracterizes the nature of the underlying assets, the financial resilience of the corporate entities involved, and the historical mechanics of technological revolutions.
So let's start with the assets. You just said GPUs are like subprime mortgages because they depreciate quickly. But the counterargument is that this AI capital is building something tangible, something real.
That's the core of it. The most glaring analytical deficiency in the subprime analogy is the physical and functional nature of the asset class. The 2008 crisis was amplified by synthetic derivatives, CDOs squared, credit default swaps, that completely decoupled financial risk from the underlying physical asset. Trillions were bet on a minuscule pool of physical housing.
Right, abstract bets on abstract bets, almost.
In stark contrast, the capital in the AI boom is physically materializing into highly tangible, extraordinarily advanced industrial infrastructure. We're talking gigawatt-scale data centers, vast networks of subsea fiber optic cables, specialized power generation facilities, advanced semiconductor fabrication lines.
So even if the startups fail, the data centers don't just disappear. They're still there, working.
Exactly. Macroeconomists often use the Carlota-Perez framework of technological revolutions. These bubbles aren't always destructive anomalies. They're historically necessary mechanisms to lay the physical groundwork for subsequent eras of economic growth. Think of the railway mania, mass electrification, or the fiber optic boom of the 90s. They all involved periods of intense, speculative euphoria that resulted in a massive, necessary oversupply of foundational infrastructure.
So the argument is, even if the immediate financial valuations collapse, the physical assets retain inherent value, a data center is still a data center.
Yes, a hyperscale data center in Texas with secured access to 1.2 gigawatts of power isn't just going to evaporate if its current tenant goes bankrupt. It will be repurposed, acquired at a discount, and utilized to power the next generation of digital commerce or traditional computing. The systemic destruction of value we saw in 2008, where abstract financial derivatives literally evaporated to zero, is physically impossible when capital has been converted into high-grade industrial infrastructure.
That's a powerful counterargument. What about the balance sheets of the companies involved? You said the hyperscalers are funding a lot of this. Are their balance sheets more resilient than the banks in 2008?
Vastly more resilient. The subprime crisis was a meltdown because toxic assets were held directly on the balance sheets of highly leveraged commercial banks with razor-thin fractional reserve ratios. When housing declined, their equity buffers were wiped out, making the system insolvent.
And today's tech giants?
The corporate entities driving the AI boom are completely different. Microsoft, Google, Amazon, Meta, these aren't highly leveraged commercial banks. They are the most prolific cash-generating corporate entities in history. Despite massive capital expenditure, they fund the vast majority of their infrastructure buildouts through internal free cash flow generated from existing, highly profitable software and advertising businesses.
So they're not reliant on external debt in the same way.
Not to the same systemic degree. While some, like Oracle, have taken on more debt for aggressive AI expansion, the broader big tech ecosystem has hundreds of billions in liquid cash reserves and maintains pristine AAA or AA+ credit ratings. They're fundamentally insulated from immediate credit market shocks.
And what about the debt that is being issued to finance third-party data centers or neoclouds? You mentioned it earlier as a point of concern.
That debt sits atop massive, deeply subordinated equity buffers. Venture capital and private equity firms are willingly absorbing the highest risk tranches of the capital stack. If an AI startup fails, the VC equity is wiped out. While painful for those investors, it doesn't trigger a systemic banking crisis because the risk is concentrated among institutional investors deliberately operating with high-risk capital, not retail banking institutions using FDIC-insured consumer deposits.
So the system has a bigger shock absorber built in this time. That makes sense. What about the idea that AI startups are subprime borrowers with no value? Is that entirely true?
The argument that AI startups are functionally equivalent to subprime borrowers relies heavily on the premise that generative AI has no genuine commercial value or ROI. But empirical data from enterprise deployments in 2025 and 2026 sharply contradicts this. While consumer-facing wrapper apps have struggled to monetize, deep enterprise integration has yielded profound, measurable back-office efficiencies.
So real businesses are finding real value in AI. It's not just hype.
Exactly. Organizations are seeing substantial ROI, not just theoretical labor reduction, but hard elimination of external business process outsourcing, 30% reduction in creative costs, and millions in annual savings on outsourced risk management through agentic AI workflows. Success is shifting from cost savings to speed to insight, compressing decision cycles from weeks to seconds.
That's a massive force multiplier. So the technology is useful and it is generating returns in some cases. That's a key divergence from subprime. And what about the cost side? You talked about plummeting GPU values.
Well, simultaneously, the supply side is undergoing rapid, violent cost deflation. This actively improves unit economics. The fundamental flaw in the subprime analogy's assumption of perpetual unprofitability is its failure to account for algorithmic deflation. The emergence of new reasoning architectures like DeepSeek V3 from China has violently compressed the compute intensity.
Violently compressed? What does that mean?
DeepSeek's innovations reportedly reduced training costs by approximately 18 times and inference costs by a staggering 36 times compared to previous models. As inference costs plummet exponentially, the profitability of AI applications radically improve, allowing startups and enterprises to achieve positive unit economics without requiring massive immediate revenue scaling.
So the tech is getting dramatically cheaper and more efficient to run, which could solve some of the revenue void over time. And finally, what about that rapid depreciation of GPUs? Is that being accounted for properly?
Critics of the bubble thesis challenge the idea of a depreciation wall. While frontier model training needs the newest silicon, the hardware doesn't instantly lose economic utility. Hyperscalers and sophisticated neoclouds are using component-based depreciation under GAAP ASC 360.
What's that?
What's that? It allows companies to segment their complex infrastructure into components with different lifespans. So the rapidly obsolescing GPU module itself can be aggressively depreciated over 3.5 to 4.5 years. But the surrounding heavy infrastructure, the server chassis, advanced networking, power distribution, liquid cooling, can be legitimately depreciated over a much longer 6 to 8 year useful life.
So it's not all or nothing. Parts of the asset retain value longer.
Exactly. And an older GPU isn't useless. When it's retired from the most demanding training tasks, it cascades down the value chain to serve as a highly efficient inference engine for less intensive applications, significantly extending its economic viability. So the accounting reflects operational reality, not malicious earnings manipulation.
So, to summarize the critique, the assets are tangible, not synthetic. The big players have fortress balance sheets. Risk is concentrated in private equity, not retail. AI has real enterprise ROI, and costs are falling rapidly due to algorithmic efficiency. And depreciation is managed more rationally. That's a pretty strong case against a full-blown 2008 repeat.
It certainly is, and it's why many argue that while there are similarities in financial engineering, the outcome won't be the same.
Okay, so we've heard the compelling case for the AI subprime echo, and then we've heard an equally compelling critique arguing why it's different and won't be a repeat of 2008. So where does that leave us? Is it a bubble or not?
This is where we need to synthesize the arguments and look at the systemic vulnerabilities that still remain, even with the critiques in mind. While it's true that the generative AI boom isn't a perfect replica of 2008, largely due to the tangibility of the infrastructure and the cash generation of the hyperscalers, the critique often fails to adequately address severe systemic vulnerabilities building rapidly in the peripheral debt markets.
So big tech might be fine, but the smaller players and the wider financial system could still be in trouble.
Precisely. The fact that Microsoft, Alphabet, and Amazon can survive an AI investment downturn doesn't mean the broader fixed income, private credit, and utility markets are immune to a catastrophic repricing of risk. The core issue isn't big tech's insolvency, but a severe maturity mismatch in debt markets, extreme counterparty concentration, and mounting regulatory hostility towards the very mechanisms sustaining the ecosystem's unnatural growth.
Let's go back to that maturity mismatch you mentioned earlier with the GPUs. The critique said component-based depreciation handles it, and older GPUs get repurposed. Is that enough?
The robust defense of component-based depreciation completely ignores the ruthless, highly volatile reality of the secondary hardware market. In traditional project finance, debt maturities align with the operational life of the asset, a 20-year loan for a 30-year power plant. But in the AI neocloud sector, multi-billion-dollar credit facilities are aggressively extended based on the current collateral value of NVIDIA H100s.
So the debt is still longer than the useful life of the most critical component.
Exactly. While underwriting models might assume a smooth 5 to 7 year depreciation, the rapid deployment of next-gen architectures destroys the residual value of previous hardware at a highly nonlinear rate. By early 2026, refurbished H100 units dropped to 70 to 75% of their original price, with heavily used units plummeting to 45 to 55% in just 3 years. That's a severe midlife inflection point where collateral value drops faster than the debt amortizes.
That's a scary thought for anyone holding that debt. And you also mentioned rental prices collapsing. How bad is that?
Alarmingly bad. The actual revenue engine supporting this debt, the hourly cloud rental price for an H100 GPU, has completely collapsed. During the peak scarcity of late 2024, rental rates were $8 to $10 an hour. By early 2026, due to massive oversupply and aggressive price competition, rates crashed to between $138 and $285 an hour.
Wow, that's an 80% drop in some cases. How does that affect profitability?
Financial modeling suggests that once H100 rental prices fall below $165 per hour, the revenue generated no longer recoups the initial investment or services the associated high-yield debt. As rental yields collapse beneath this threshold across the market, the neoclouds, operating on incredibly thin margins and burdened by high interest payments, will be forced to default on their GPU-backed loans.
So the lenders will try to seize the collateral, the GPUs.
Yes, but they'll find themselves taking possession of rapidly outdated hardware in a completely oversaturated secondary market. They'll be forced to realize massive, unrecoverable haircuts on their principal. This severe maturity mismatch, funding assets with a 1 to 3 year functional economic life using inflexible debt structures designed for 5 to 15 year infrastructure, is a textbook precursor to a localized, violent credit crisis.
So a localized credit crisis rather than a global one, but still significant. What about concentration risk?
The system's resilience is compromised by profound hidden concentration risk. The AI ecosystem isn't decentralized. It's a deeply interconnected oligopoly highly vulnerable to single points of failure. Take CoreWeave, a prominent neocloud. Credit rating agencies show a staggering 77% of its revenue comes from just 2 counterparties, Microsoft and NVIDIA.
So if Microsoft changes its strategy or those zombie startups don't renew their leases, CoreWeave is in deep trouble.
Absolutely. A liquidity crisis for highly leveraged neoclouds would then transmit directly into institutional debt markets. The $1.5 trillion in investment-grade bond funding, $150 billion in leveraged loans, and tens of billions in ABS projected to fund this sector are held by conservative entities, public pension funds, life insurance companies, private credit vehicles. A wave of neocloud defaults would deeply impair these institutional portfolios, forcing a severe contraction in broader corporate credit availability.
That sounds like it could affect a lot of people's retirements. And you also mentioned public utilities. How about that?
Yes, this concentration risk physically manifests in the public utility sector. Power grid operators forecast data center demand to drive U.S. electricity consumption up by as much as 25% by 2030. Utilities are undertaking massive, capital-intensive projects to build new power generation and transmission. But if anticipated AI workload growth doesn't materialize, perhaps because hyper-efficient models like DeepSeek reduce power demand, these utilities face severe stranded asset risks.
And who pays for that? The massive capital costs of these underutilized multi-billion-dollar power plants would inevitably be passed directly onto captive residential ratepayers. This transforms a Silicon Valley financial miscalculation into a highly regressive, broader macroeconomic tax burden.
So the public ends up footing the bill for private sector overinvestment. Finally, what about regulatory intervention? Could that burst the bubble?
This is perhaps the most potent systemic threat. The circular financing loops sustaining inflated revenue figures, hyperscalers investing in AI startups in exchange for exclusive cloud computing commitments, have drawn intense scrutiny from global antitrust authorities.
They're cracking down on the round tripping?
The FTC and CMA have launched aggressive inquiries. Regulators correctly perceive these structures as anti-competitive, ensuring startups are locked into specific cloud ecosystems, consolidating hyperscaler market share without triggering formal M&A review. If regulatory pressure forces the dismantling of these circular structures, or if the SEC strictly enforces ASC 606 to prevent revenue recognition lacking independent commercial substance, the psychological and financial pillars of the AI boom will fracture instantly.
So if that artificial life support is pulled, the whole thing could collapse.
Without the hyperscaler vendor financing, the subprime borrowers, the cash-burning, heavily leveraged AI startups, will instantly lose their purchasing power. Demand for high-margin compute will evaporate overnight, leaving the highly leveraged neoclouds with vast, empty data centers, triggering automatic defaults on their asset-backed securitizations, and initiating the precise systemic unwind the market currently believes is impossible.
So, to sum it all up, it's not a perfect rerun of 2008, but the underlying financial mechanisms are dangerously similar. And while the big players might weather the storm, a fragile periphery could still experience a severe localized credit crisis.
Exactly. The physical assets built will ultimately benefit society, but the extreme financial engineering virtually guarantees that the current class of creditors and investors will face severe, subprime-style capital destruction.
All right, let's bring it all together. What are the key insights listeners should take away from this conversation about AI's potential subprime echo?
First, recognize that AI's shift from software to heavy industry has created unprecedented capital intensity, far exceeding organic revenue growth. We're talking trillions in spending with a $600 billion annual revenue gap. Second, the parallels to the 2008 subprime crisis are structural, not superficial. Complex financial engineering like GPU-backed ABS, circular vendor financing, and off-balance sheet SPVs are masking risk and inflating reported revenue. Third, the AI startup functions as the subprime borrower in this ecosystem, largely reliant on continuous capital injections rather than organic profitability, creating a fragile base. Fourth, while hyperscalers have robust balance sheets and AI offers real enterprise ROI, insulating parts of the market, this doesn't protect the broader, fragile peripheral ecosystem of neoclouds and institutional debt holders. And finally, severe maturity mismatches, plummeting GPU rental yields, concentration risk, and potential regulatory intervention could trigger a localized, violent credit contraction, particularly impacting private credit, leveraged loan markets, and even public utilities.
Those are some incredibly sobering takeaways. This isn't just about tech, it's about the financial plumbing underneath it all. So, listeners, here are a couple of questions to ponder. How much tangible economic value does your organization actually derive from AI today? And how much of that is funded by organic revenue versus venture capital or vendor financing? And if the cost of AI compute continues to plummet, what does that mean for the profitability of the companies currently building these multi-billion-dollar data centers? That's all for this episode of Tech Disruptions. Thanks for listening. We'll see you next time.
Stay curious out there.